Welcome to StokTok's deep dive into Texas Instruments. Texas Instruments designs and manufactures semiconductor chips used in everything from industrial equipment to automotive systems to data center infrastructure. At the time of recording, the stock was trading at $277.14. The 52-week range runs from $152.73 at the low to $284.12 at the high. The Relative Strength Index, or RSI, a momentum oscillator that measures the speed of price movement, is sitting at 83.6, which typically signals an overbought condition. The 50-day moving average stands at $209.65, while the 200-day moving average is at $190.05. The stock has rallied 19.17% from its lows. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Texas Instruments is one of the world's largest semiconductor design and manufacturing companies, with a focus on analog chips and embedded processors. The company's core business is selling highly specialized silicon to manufacturers in industrial, automotive, communications, and computing verticals. Competitors face high barriers to entry due to Texas Instruments' deep customer relationships, manufacturing scale, and intellectual property moat. The StokTok score for Texas Instruments is 51 out of 100, a hold rating. Breaking that down, valuation scores 10 out of 20, financial health scores 14 out of 20, profitability is quite strong at 18 out of 20, growth is minimal at 1 out of 20, and smart money positioning scores 8 out of 20. This is a story where earnings quality is excellent, but the stock price has moved ahead of fundamental growth. Now, valuation. The question every investor has to answer: are you paying the right price? The trailing 12-month price to earnings multiple, or PE ratio, is 42.25 times. For context, that is materially above the long-term average for semiconductor companies, which has historically traded somewhere in the range of 15 to 25 times. The forward PE, which values the company on expected next year earnings, is 35.56 times. The price-to-earnings growth ratio, or PEG, which compares a company's valuation to its earnings growth rate, is 0.00. This metric is essentially incalculable in the traditional sense because Texas Instruments has negative or minimal growth. The enterprise value to EBITDA multiple, which is earnings before interest, taxes, depreciation, and amortization, is 26.47 times. That reflects significant premium valuation for a mature, slow-growth semiconductor business. In our view, the company's moat is real. It has sticky customer relationships and exceptional manufacturing scale, but the current price does not reflect a growth narrative. Wall Street analysts at the time of recording have a consensus mean price target of $266, suggesting limited upside from these levels. The analyst consensus leans slightly toward buy, with a range from $200 on the low end to $330 on the high end. The GuruFocus Value estimate stands at $191.35, implying the stock is trading at a 20.10% premium to intrinsic value at the time of recording. Market sentiment around Texas Instruments, as of the creation of this video, leans bullish, driven by better-than-expected earnings and robust demand from data center and industrial sectors. However, that bullish sentiment has already been priced into the current valuation. Our take: valuation is stretched. The risk to reward does not favor new money at these levels. Moving to financial strength, how solid is the foundation? The Piotroski F-score, which is a 9-point health checklist that examines profitability, leverage, and liquidity, comes in at 6 out of 9. That is a yellow flag. The score indicates adequate financial health but not exceptional strength. The Altman Z score, a bankruptcy risk model that combines 5 financial metrics, sits at 10.45. Any Z-score above 2.99 is considered safe from insolvency, so Texas Instruments is in solid territory here. Debt and cash flows are where we need to pay attention. The cash-to-debt ratio is 0.35, meaning the company has roughly $1 of cash for every $3 of debt outstanding. That is not concerning for a capital-intensive semiconductor business, but it is not fortress balance sheet territory either. Interest coverage. The number of times operating earnings cover annual interest expense is 11.31 times. That is healthy and indicates the company can service its debt comfortably. The current ratio, which measures short-term liquidity, is 4.35, reflecting strong cash reserves and working capital. Debt to equity is 0.86, which is moderate leverage for a business of this scale and stability. Our verdict: the balance sheet is sound but not exceptional. Texas Instruments is financially stable and carries no meaningful default risk, but it is not sitting on a war chest of dry powder either. Next up, profitability. Is this business actually making money efficiently? The return on invested capital, or return on invested capital, is 19.56%. That is an excellent result and sits above the weighted average cost of capital for semiconductor businesses, meaning every dollar Texas Instruments invests generates more than $1 of economic value in return. That is the hallmark of a company with genuine competitive advantage. Drilling down the profit margin stack, gross margin is 57.02%. That is exceptionally high and reflects the company's pricing power and manufacturing efficiency. Operating margin, profit after you subtract operating expenses, is 34.73%. Net margin, the true bottom line profit, is 28.28%. For every revenue dollar, the company keeps roughly 28 cents of profit. Those are world-class numbers. Free cash flow margin, which measures the cash the business generates after capital expenditures, is 14.72%. This matters because a company can manipulate earnings on the income statement, but cash flows do not lie. Texas Instruments converts roughly 15 cents of every revenue dollar into actual cash available for shareholders. Return on equity, the return shareholders earn on their invested capital, is 30.27%. Return on assets is 14.39%. In our view, the profitability story is the strongest part of this company. Management has demonstrated exceptional operational discipline and pricing power. Onto growth. Is this business expanding and at what rate? This is where the thesis gets complicated. Over the trailing 3 years, revenue has declined by 4.10% annually on average. Over the past 5 years, revenue has grown by only 1.60% per year. That is essentially flat. Texas Instruments is a mature, stable semiconductor manufacturer sitting in a very cyclical industry. The company is not in a growth phase. Book value, which represents shareholder equity per share, has grown 3.70% over the past 3 years. That is modest and reflects the fact that earnings are being distributed to shareholders rather than reinvested for expansion. The dividend yield is 2.42%. Which is meaningful income for a semiconductor stock, but below what you would see at a true utility or rate. Here is the critical insight. Texas Instruments trades on the back of cyclical demand tailwinds. Currently, data center investment and industrial spending are strong, but those tailwinds are temporary. When chip demand normalizes, so will the stock price. The growth score of 1 out of 20 reflects this reality. The company is not broken, but if you are paying a 42 times PE multiple for a flat growth semiconductor manufacturer, you are betting on mean reversion never happening. One might argue the case that the data center cycle has multiple years left, but that requires conviction and timing skill. Now let's talk smart money. What institutional capital is actually doing with this name? 24 top-tier gurus and super investors, as tracked by GuruFocus, currently hold Texas Instruments. That is a significant amount of smart money presence. Looking at recent activity, Torrey Funds, which allocates 3.73% of its portfolio to Texas Instruments, has been adding shares, increasing its position by 22.56%. Terry Smith at Fundsmith, which holds 2.66% in the stock, has actually been reducing slightly, down 3.61%. David Katz at Matrix Asset Advisors holds 2.46% and has been adding, up 3.27%. Christopher Davis at Davis Advisors holds 2.22% and has been quite aggressive in adding, up 23.12%. Wallace White's at White's Investment Management holds 1.70% and has made a minimal add of 0.32%. The big picture. 3 of the 5 largest Guru holders are adding to their positions, suggesting confidence. However, there is mixed conviction. Not everyone is aggressively loading the boat. On the institutional side, 12.2% of 13F filers are net buyers, meaning they hold more shares than they are selling. That is not particularly bullish. Insider ownership is very low at 0.53%, meaning management owns virtually no stock in the company. In the past 3 months, insiders have executed 0 buys and 7 sells. That is not a ringing endorsement. When management is selling and not buying, it often signals they do not view the current price as attractive. Our take: the Guru community is moderately bullish, but not unified. The institutional base is lukewarm. Insiders are net sellers. This suggests even some of the smartest money in the room has reservations at current levels. And finally, the verdict. Let's bring it all together. On valuation, in our view, the stock is priced for perfection. A 42 times PE multiple on a no-growth business is stretched, even if earnings quality is exceptional. On financial strength, the company is solid but not fortress-like. The balance sheet supports dividends and buybacks but does not provide meaningful margin of safety at current stock prices. On profitability, this is genuinely best in class. The return on invested capital, operating margins, and cash conversion are excellent, and management has demonstrated exceptional operational discipline over many cycles. On growth, the thesis is weak. Negative 3-year revenue growth and flat 5-year growth is not compelling, even with cyclical tailwinds. The company is harvesting value rather than creating it. On smart money, conviction is mixed. Some gurus are adding, but insiders are selling, and institutional momentum is not particularly strong. The overall StokTok assessment: hold. We would not chase the stock at $277, but we would not aggressively short it either. The setup looks interesting to us for investors who miss the move and are willing to wait for a pullback to the $180 to $190 range. That would offer a margin of safety and a more attractive risk-to-reward profile. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Texas Instruments. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.